Hi, welcome to Introduction to Accounting 1. For this class, I will be briefing you on the Introduction to Accounting, and before I do that, I would like to share with you basic outlines for the semester or the course. Now, as you can see, these are the outline and the basic topics you need to be grounded on before you go into deep accounting, the intern. However, on this class, I am going to be taking you on the introduction to accounting. Now, for this class, I will be taking the first part of the course outline, the introduction to accounting. The meaning, the uses, the function, the four questions in accounting, and lastly, the source documents. Tag along to continue. Now, what is accounting? I know most of you have heard of accounting, most of you know what accounting is, and most of you don't even know what accounting. Don't worry, I got your back. I'm going to give you two definitions of accounting, the simplified version and the amplified version. Now, the simplified version is just for you to understand, while the amplified version is the one you have to use or if you want to use it for exams and test situations. Now, this is the simplified version. Now, accounting can be defined as the process of collecting, recording, presenting, analyzing, summarizing, and interpreting financial information of a business enterprise for the users of what the financial statement. Now, this is the simplified version. These are very simple to understand, very simple to take in, just about collecting, recording, presenting, analyzing, summarizing, and interpreting financial information. You have to use this keyword to understand. Now, this is an amplified version of the definition of accounting. It can be seen as a systematic process of recording, analyzing, classifying, summarizing, and reporting or communicating financial transactions and events of an entity. Never forget the entity to users to aid decision making, planning, and control. Now you can see the clear difference between the simplified and the amplified definition, where we have the systematic process and events to aid decision making, planning, and control. I would really advise to use this for your examinations, your tests, for your professors, your teachers, or your lecturers. This is a clear and more adequate way to define accounting. Now, in the definition, you would notice that we are reporting financial transactions and events to users. Now, you may wonder, who are the users of financial information or accounting information? Well, the next slide is going to give you a brief introduction, not all, but a brief list of people who uses accounting information. Now, who are the users of accounting information? We have the lawyers, the shareholders, we have the management, we have the bank or the lenders, we have the tax authorities, and next we have the investors and the stock brokers. So now who are the shareholders? The shareholders are just simply the people who own the business, the people who put money in the business. So the reason why they need the information is to appraise your investment. Simply, I put my money in this business, I need to see my profit. That's why they need the financial information. Now, who are the management? Now, the management and the shareholders are way different people, different entity in the same organization. Now, these are people who manage the affairs of the business, and they need to know the profitability of the business, the productivity, the efficiency, the effectiveness, and whether the business is going on a long run. That is why they need the financial information. Next on all this are the bankers and the lenders. These are the people who support the business financially. So they need to know whether or not you are credible to get a loan. That is why they need the financial business. So if I'm giving you a loan, you need to give me a guarantee that you are going to give me that loan with interest on the fixed dates. That is why they need the financial information. Now we have the tax authority. So the government provides social amenities like light, water, and road, and the business naturally reciprocates by paying them tax. So I give you this, you give me this. So the reason why the tax authority needs the financial information is to know how much a business is making in a year and how much they are meant to pay for tax. Now we have the investors and the stockbrokers. The investors are people with the cash, the people with funds, but they are searching for business to invest, not investor, to invest. Sorry for that. So these people have the cash, but they are looking for where to invest. So if your financial information isn't clicking, the investors are gone. So this is why they need it to ascertain whether or not they're going to invest in that company or not. Now, the last on all this are the lawyers. Now, you be wondering why the lawyers need my financial information to do what? See, they need it to give legal advice to their clients. So, imagine if an investor doesn't want to come in person to your business, he sends his lawyer and he gives the lawyer the right or permission to go through the accounting information, and with that the lawyer gives advice to the investor on whether or not to invest on this business or he should go. Now these are the users of the accounting information. Next on our list is the functions of accounting. Now, what is accounting useful, or what are the advantages of accounting? We have 5 functions of accounting. The first on our list is planning. Businesses uses this information to decide ahead of time what to do, when to do, and how to do it. The next on our list is decision making. The management uses this information for effective decision making, while other users like the investors use it to determine whether or not he or she is going to invest in your business. The third on my list is tax. As said before, this enables the government to know how much you are meant to pay tax as a business. The fourth one is to enable trade unions to negotiate better conditions of services. The last on my list is to ascertain the profitability position of the business. Now, these are the functions of accounting information, or just accounting. Now, for some of you, this 4 questions of accounting might be new to you, while to others might just be a normal part of accounting. Now, I would like to share with you as new knowledge or as ground knowledge 4 questions of accounting. The 4 questions are seen. The first one is when to debit and credit, what to debit and credit, how to debit and credit, and where to debit and credit. For today's class, I will not be answering all the questions, but I will be answering one, because one of the questions leads to the final stage of this class, which is when to debit and credit. Now, when to debit and credit? This is the answer. Now, debits and credits are made when, note, when financial transactions and events occur. Now, what is financial transaction? This is the exchange of goods and services with the attachment of a monetary value. So imagine going to a shop and you want Coke. So you ask him for Coke, he asks you for money. So you give him money, he gives you Coke. Or you go to a shop or hair salon, you sit down and you give him money and he does your hair. That is an exchange of goods and services for money, or monetary value. Now, financial event is more different. You cannot calculate it in an absolute quantity. So it's kind of a sudden occurrence or a natural occurrence that is attached with the monetary value. For example, a loss or flooding or any natural occurrence that can disrupt the operation of a business. But with that, you have to attach a monetary value to it. Now note that financial transaction and events take place when there is evidence. So how would you know that financial transaction and evidence actually occurred? Is when the evidence is seen. And these evidence are known as the source document. So without a source document, you will not actually know whether you actually transacted. Is that correct? You actually had a financial transaction or an event with a person or a business enterprise. Now, this brings us to the last stage of today's class, source documents. Now, before you are two samples of the most popular source document you have seen personally as an individual, not necessarily as a business or as a company, but as an individual. You might have seen one of these two or even two of them. The one on the left is the invoice and the one on the right is the receipt. These are two main examples of source documents. Now, what is a source document? As seen, it is any document that is issued or received to acknowledge the existence of financial transaction and events. Simply put, these are evidence that a financial transaction and event actually occurred. These are proof to acknowledge the existence of financial transaction and events. This can be issued, that's the seller issuing to the customer and the customer receiving from the seller. That's issuing and receiving. Now we are on the types of source documents. First on our list is the invoice. Here is a good image of what an invoice looks like. Most of you have seen it, most of you haven't. So now what is an invoice? Now an invoice is a source document issued or received as evidence of the value of goods bought or services rendered. Now note, an invoice is not the payment of goods. It's just a document that lists out the value of goods, the items, and the total amounts of goods bought or services rendered. Now, if you're given an invoice, it's either on a credit based, that means you bought these goods and you have not yet paid for it. That is what an invoice is. An invoice is issued when the goods are not paid for. Now, when the goods are paid for, you're going to be issued another document known as the receipt. Now, this image, each and every one of us have seen what a receipt look like. Now, a receipt is showing the payment of goods and services rendered. This is simply paid invoice. While invoice is showing the value of goods, receipt is showing the payment of those value of goods. I don't know if you get me. So receipts are paid invoice. Now, next on my list is the credit note. And the credit note is issued under the following condition: when the customer is overcharged and when there is a sales return. Now, what does it mean for a customer to be overcharged? Now, imagine going to a supermarket and you want to buy a Coke, and on the normal price, the Coke is for $10 or 10 naira, and the person charged you for $20 or 20 naira. You have been charged over by what? $10 or 10 naira. Now the seller sends this note to you telling you that, look, I have overcharged you of $10, so I am owing you $10. This is what a credit note is for. On the second consideration, we have sales returns. Imagine if you're a company or you're a business and you sell a pen to a customer, and later on that day the customer comes back complaining that the pen isn't working. That is what we call sales returns. Returning goods or services, not services, mostly goods, after sales. So you are owing the customer a pen or an amount attached to the pen. That is what credit note is all about. I haven't seen a credit note, so I had to Google what a credit note look like. And here in front of you is a proper credit note issued to a customer by a seller. Now, if there's a credit note, there's obviously a debit note. So what's a debit note? A debit note is all about issuing a document by the seller to the customer showing that the customer has been undercharged or when there's a purchase return. So for credit notes, the customer is overcharged and there's a sales return. For a debit note, the customer is undercharged and there's a purchase return. Now let me give you an explanation of undercharge. Now, you go to the same supermarket and you buy Coke for $5, not $10, this time $5. And the seller tells you that, okay, look, I sold this Coke for you for $5 instead of $10, which means you owe me amount of what? $5. So now you are in debt to the business. Now for credit notes, the business is in debt with you, but a debit note, you, the customer, are in debt to the business. Now, when there's a purchase return, now for a business that conducts buying and selling, a business obviously buy goods from other people, other manufacturers, other producers. So when they buy goods and these goods turn out to be damaged or spoiled, they send them back. So they purchase and send them back. So that the act of sending them back is known as purchase return. So imagine as a company, you buy a crate of egg and 10 of the eggs are bad. Out of 20 or out of 30, 10 of the eggs are bad. You have to send those 10 eggs back. Those 10 eggs sent back is known as a purchase return. So as a seller, you are going to give a supplier a debit note. Now, note that the seller gives a customer when it's undercharged and gives a supplier when there's a purchase return. Consignment note. First of all, what's a consignment? A consignment is more like sending goods from the owners to the agents or to the person selling on behalf of the owner. But I don't want to bore you with that. Let's just go straight to the consignment note. The consignment note is a document that accompanies goods to be delivered to the agent. So now most of you who have been to the bank or work at the bank must know or must have seen this slip. And this slip in front of you is known as the deposit slip. So this slip is issued by the bank to the customer who wants to deposit a particular amount to an account. So you go to a bank and you have your cash and you want to either put that money in your account or in another person's account. So the bank is going to give you this slip in front of you for you to fill in the necessary information before sending the money or paying the money to an account. So this is a document acknowledging the money has been paid into the bank. So you can see it. I've held it before. I've used it before. Most of you have. This is a proper image of what a deposit slip look like. So if you haven't seen it before, look at it now You have to write the account details, the account name, account number, and all these details must be filled before payments is being done.